What's going on, good people? I hope everybody is doing well. I came here today to do part 2 for my trades and tactics video series, and today I want to talk about trades and tactics that you need to avoid. Now, I have 22 things to talk about, so let's go ahead and get right into it. So number 1, buying the lows of a higher low is the best entry for a downtrend reversal that has a higher low that gets established, or for when you want to use the higher low strategy even when you're in an uptrend. You always want to draw your level of support based off of the lows for whatever higher low was established. So let's take a look at trade 1. Now, I went long here during the upswing as prices came back to retest the support level of a higher low, and this was on August the 2nd. Now you're looking at this trade saying, okay, it was positive, but this trade was only for like maybe 20 something points. This trade could have been maybe 30 to 40 points if I would have bought low. So notice how we have the level of support for the higher low. The wicks come down to this level where the circle is. So really my level of support should not be up here where the bodies are at. The levels of support should be down here where the wicks are, because I went long right here on the red candle at the bottom of these bodies. Now, if I would have went long when prices came back to retest this wick over here when they did so on this one green candle, I would have been able to catch it from the bottom and then catch this whole move back up to the top of the zone. So even if your trade does work, you still can get more from your trade by actually going long at lower prices and better prices. And a lot of times, like if we look at this example from August 11th this year, look at trade number 1. I went long as prices came back to retest the support level of the higher low, but there were also 3 higher lows from before at A, B, and C, which is cool. But you still also want to make sure that you go long at the lowest possible levels. Let's zoom in a little bit. Look at trade 1. I went long towards the bodies, but if you look at the level of support, the level of support was drawn off the lowest level for this higher low wick. So if anything, I should be going long down here. And if you look at the price action, look at how once we actually formed that pivot point that pushed us back to the upside, we formed that pivot point and we closed right on top of that support level that was drawn. So whenever you use this higher low setup, it might be so tempting to go long at higher prices because you might feel as though the level of support is too far away. Prices are not going to come and try and test those again. But I can say that maybe 7 out of 10 times prices are coming back to retest that lowest wick. So even though it seems tempting to go long at the bodies, make sure you go long at that lowest level of support that you can possibly get. Very important. So let's move on to number 2. Let levels get tested first before you place your orders, and be patient. And that is so important because a lot of times in the market, you might have an idea about a certain level holding up, but you never know how much momentum is going to come into the market as prices come to that level. So you don't know if prices are going to reverse at that level, or if they're just going to keep pushing through. You just have a good idea, but you never have 100% certainty. So you got to wait, let levels come back, get tested, and then once you see the reaction that you like, then you can kind of look for the trades that you were trying to place. So let's go ahead and look at a couple of examples. Let's see, where is it? Not on that one. Let the levels get tested first. That's a good example. Here we go. Okay, let's look at trade number 15 from August the 3rd this year. So notice how up until this point we had a downtrend that started from around 10 o'clock, pushed down to the bottom of the zone. From that point forward, the uptrend started back. We had higher highs and higher lows. So eventually we pushed back up to the top of the chart, came back to this level of support where the blue line is at 14 and 15. Now if you look at 15, I went long at support, but in a pullback you have to wait for that first higher low. And that's actually going to touch on one of the topics that we're going to talk about later also, which is in a pullback, you got to wait for that first higher low. Don't try and anticipate that level of support holding up, because when I went long at 15, I just assumed, oh, okay, this is the level of support from the higher low that got established over here by trade number 11. So more than likely, this should definitely hold up, right? That might be the idea that you have, but you want to see prices come into that level. Then you want to see the reaction that you were looking for. So in this scenario, I was looking for the uptrend to continue. So what I should do is let prices come into levels of support. Then when I see prices bounce away and create that higher low, then I have the confirmation that I need to go ahead and start taking the trades that I was looking for. But it's so important to let those levels kind of show themselves and let the levels show you what they want to do. You don't tell the levels what it wants to do. The levels tell you what they want to do, and then as a trader, you just act accordingly based on that information that you're receiving. So number 2, let your levels get tested before you place your orders. Be patient. Okay. And also, extra notes. If you miss the move, it's all good. Use your patience. Opportunity is abundant. And I think that's the biggest mindset that is important to have when you're using rule number 2. The only reason that I usually like to go long and try and anticipate a level is because I'm just so excited about the opportunity in front of me. But it's like, look, man, opportunity is there all day. If you don't get this one, you'll get the next one. If you don't get the next one, you'll get the one after that. The market is open for what? From 9:30 to 4 o'clock. That's what, 6.5 hours. It's so much opportunity available. Just be patient. That's it. So let's move on to number 3. Buying high is unreliable. This only works for post patterns, and post patterns rarely show up. So I actually did a video on post patterns. Let's go back to it real quick. Which one is it? Which one is it? Oh man, it's one of these. I ain't gonna lie. I remember it though. Hold on. Okay, here we go. Go back to trading my live account, day number 27. It's in my playlist for trading my scalping strategy right here. So make sure you go check that out. Day what day was that? Day 26. But yeah, let's get back focused though. Get back focused. So yeah, when you have post patterns, those rarely show up, but when they do, that's really the only time you want to go long at higher prices. And then on the flip side, another one of the rules that I have coming up a little bit later is don't go short towards the lows of a swing during the downtrend. The same way you don't want to go long towards the highs of a swing during an uptrend. So let's look at some examples real quick. Now let's look at August the 7th from this year, and let's look at trade 4 and let's look at trade 5. Now at trade 4, we can pretty much see that this was one of the highest prices for the day up until we broke out a little bit later at trade 7 and trade 8. But at trade 4, I went long here as prices retested the higher low. I cut the trade at break even when I saw the buy and dry up a little bit. And that makes sense because if you're at the highs of the day, you'll probably see a lot of profit taken because people that were long all the way from 0.1, from 0.2, all the way throughout this spike to the upside, all of these people eventually have to take profit at some type of level. So if we get to the highest prices for the day, it will make sense that, yeah, they will probably take profit right there. So when you get to those highs, it's not always guaranteed that profit taking is going to happen and have enough momentum to push the market down, but you got to expect for this thing to happen. People will take profits. That's just a part of the market cycle. So if you're at the highest prices, wait for a pullback. And then once you get to a level of support where that level of support holds up and you see prices move off and make a higher low, then you can start going long once again. But going long towards the high of a swing just drastically decreases your opportunities of being able to make money unless you want to trade with a super wide stop. But because I have a strategy that uses very tight stop losses, I can't afford to take wide entry types of positions, so I cannot go long at higher prices at all. And then if you look at trade number 5, I actually came back and did the same thing. So I went long here based on the higher low, and this was the same trade as number 4, and I got the same results. So even in the same session, trying to go long at higher prices, it just doesn't work too often. Now it's going to work every now and then when you finally get the breakout to the upside, but if you know trading for good enough, you'll know that most breakouts actually fail. So if you're going long at higher prices, you're just not really giving yourself the best chance for success, and that's what we always want to do. And another example is from August the 10th this year, also on trades 3. So if we look at 3, I went long here, but I bought too high. Buying at the zone would have been better. And this really just comes back to what we were talking about on rule number 2, where we say patience is what you need. You don't have to feel like you're going to miss the move. It's going to be opportunity all day. So if you see prices moving away from you, just accept the fact that they moved on without you and just wait for the next best opportunity, which in this case would have been a pullback to the bottom of the zone. So anytime you feel the market moving away, just roll with it. It's all good. You're not missing out. I promise you. So that's really the biggest thing about it. It's just the mindset when it comes down to these types of trades. You got to remember that the market is not going to move without you. I promise. I promise. I promise. I promise. Always remember that when it comes to rule number 3. Buying high is unreliable. Just be patient and wait for your best setups to come around. Let's move on to number 4. So number 4, whenever you get conflicting signals, just skip that trade. Number 4, trading during uncertainty leads to lower quality setups, and I need to eliminate the low quality setups because a lot of times in the market, I come in and I follow my trading plan and I take some really good entries. I have some really good trades, but then in between those good trades, I start taking these really subpar, low efficiency, low probability trades that just don't work for me because I have a feeling like I feel like it could go up, but it could also go down. I could argue both sides, but I feel like it's going this way, so I'll pick this one. That's not always what you want to do. You want to just, if you have 2 conflicting signals, just wait for more clarity in the market. You know, it's nothing in the market that forces you to trade. All of the decisions that you make are solely up to you. It's your choice. All of the opportunity is in your hands, and therefore all the responsibility is in your hands. So if you don't want to take that trade, you don't have to. So a good example is from August 10th this year. Let's look at trades 5 and 5A towards the top of the chart up here. So if you look at it, I actually went long right here on the first trade based off of a double bottom setup and then a higher low that got formed, which made sense because we were in an uptrend leading up to this highest price that we made towards 35,640. Now, once we made that high for the day, we pulled back, created a lower high. From that point, we took the swing high and the lower high, connected those, extended it throughout the market, and that's how I got this bear trend line. So I'm seeing the bear trend line, and I'm like, that's interesting. But I also know one of my rules that I'll get into a little bit later is also don't trade the first pullback. Don't trade the counter trend trade during the first pullback in a very strong trend because sometimes that trend might just reverse. So I'm looking at the double bottom like, oh, okay, this is why you don't trade that first reversal because we got a double bottom and a higher low. The uptrend is about to continue. So we had that uptrend, well, those bullish signals starting to pop up, but we also had the bear trend line above. So it's like, which one do you follow? Do you follow the double bottom and a higher low, which says you should go long, or do you follow these lower lows and lower highs and a breakdown below the zone at the same time? Like, which one do you do? Well, the beautiful thing about it is that you don't have to pick one. You can just simply sit back and say, I could argue both sides right now. So therefore, I'm going to wait for the market to really start trending in a direction where I can't even argue what's going on. It's clearly obvious what's happening right now. And that's pretty much what happened at trade 6. Notice how once we finally started breaking out to the downside, we could all see that the trend was down because we had lower lows and lower highs after a strong uptrend. We broke down below the zone, came back to retest the bear trend line, and then sold off. So now it's a lot more obvious where the market wants to go. So now you can start looking for your trades and do what you need to. But always remember, man, it's never any pressure in the market. The market is going to be here today, next week, next month, next year. If you don't catch it today, you can catch it tomorrow. If you don't catch it in the morning, you can catch it in the afternoon. It's all good. Just be patient, man. That's all it really comes down to. So then let's move on to number 5. Shorting from low prices is unreliable. All right. This only works for bear trend line zone breakouts. Short from higher prices for all setups except for the bear trend line zone breakout. And that is so important. Like, man, I can't tell you how many times I just got caught with the FOMO type of mindset where I had fear of missing out. And because of that, I just shorted from lower prices. Now, let's take a look and look at some examples of why this happens. Let's look at trades 9 and 10 from August the 1st. 9 and 10. So let's actually start right here at 6. So at 6, we broke down below the levels of support from this zone over here from before in the market. Now, once we broke down below that, the downtrend was definitely confirmed. So we come back to test the purple line. That was the previous session's closing price. I took the short trade at trade number 8, took it from the top of the zone back down to the bottom. If you remember the video I made earlier talking about trade tactics that actually work, this was one of those I talked about where you have that break to the downside, a zone gets established, you wait for the prices to come back, test the top of the zone, and then you go short. That was a good trade by me. But I come back on trade 9 and trade 10 and get a little bit greedy and try and short towards the lows of the zone and the lows of this entire swing. So if you look at it, the swing started up here at 35,800, and then we pull all the way back down to 35,680. So that's about a 120 point drop in the span of about 20 minutes. So for me to go short towards the lows of that entire swing, it's just not a high probability trade, because people that are in the market that were already short, they have to take profits. Like, look at what I did at trade number 8. Even I took profits. So you got to assume that everybody else in the market is doing the same thing. So if profit taking is being done at a continuous basis at these price levels, that means that more than likely you're going to pull back. Doesn't mean that the downtrend is over, but it does mean you'll pull back to a major level of resistance. And then more than likely, that's where the sellers will step back in. And that's where you as a trader should step back in too. So that's one of the biggest things I learned on 9 and 10. And this is a mistake that I've made multiple times. You know, it's not just on that day. If we go back and look at August 4th, let's look at trade 3 and trade 4. Notice how this is very similar. My bad. Notice how this is very similar to August 1st, where we had a big swing to the downside. We had the same thing on this day on the 4th. Big swing to the downside. And then when we get to the bottom of the zone at 3 and 4, I just let the FOMO get a hold of me, man. And you got to avoid that at all costs. No matter what, you cannot go short towards the lows of a swing, because it's just an unreliable trade. Unless you want to have a super wide stop, but having a wide stop is just not an option for me. So I got to be able to avoid those trades at junctions like 3 and 4. Look at what I did at 5 and 6. I still shorted right here, but you know, whenever you have a zone, you want to respect the wicks above the zone. That's something that we'll get into a little bit later also too. That's one of the topics we have for today. But this is where you want to short from higher prices up near resistance. Do not give in to that FOMO, no matter what it might be. And on this specific day, the reason I gave into it was because yesterday's closing price, the closing price from the previous session on August 3rd, you can't see it on the screenshot, but it was like maybe 50 points below. And I assumed that since the downtrend was so strong down to this zone right here, I'm like, oh, okay, now that we broke down below the zone, we should come back, retest it right here, and then we're going right back to the previous session's closing price. But just because you have a key level below or above, doesn't mean that you should get married to that level and just assume that the market is going there because it's going in that direction. Profit taking and pullbacks can occur at any level, and you got to stay on your toes and keep your eyes open, so you don't just get lulled to sleep by a level thinking that it's automatically going there. So don't give in to the FOMO, no matter what might be below or above. Trade the market accordingly and trade from the best levels. And that's one of the biggest things I learned from rule number 5. Do not short from low prices. It's unreliable, man. So then let's talk about number 6. Trading a zone from the middle is unreliable. Only trade a zone from its extremes. And I say that because when you trade a zone, if you trade from the middle, you really open yourself up to anything happening. The possibilities are endless. If you trade from the middle of the zone, prices could come back up to the top of the zone. They could come back down to the bottom of the zone. They could whip you out. Let's say you went short at the middle of the zone. Prices could come back up to the top of the zone, stop you out. And as soon as they stop you out, they literally turn around on that one wick and come back down to your profit target. So you always want to make sure you trade a zones from those extremes. And let's look at a couple of examples. If it's gonna load up. Come on, computer. There we go. I love it. Okay, so let's look at trade number 6 right here from August the 7th. I shorted here expecting for the downtrend to continue. Don't trade the pullback in a good trend. That's something we talked about earlier too, and we'll talk about a little bit later. That's one of the topics I want to discuss also. But look at 6 right here. Now it's not like the exact middle of the zone, but upper middle, lower middle, and actually exact middle, to me, is all the same. It's within the middle of the zone. You do not want to take any entries, because look at what I did right here. Shorted from the middle of the zone, and what did prices do? They came back up to the top of the zone and stopped me out. Now, this is not a scenario where we see prices actually wick back down after they stop you out, but that has happened to me so many times. And I've just learned over the course of time, like, if you had to put a percentage on it, I would say 20% of the time, entering from the middle of the zone would be successful for you. The other 80% of the time is not going to work. And you'll be like I am when I go into these situations, and you'll look back on it and say, I knew that wasn't going to work, but why did I still do it? Because it's tricky. You know, it's so tempting. And that's the thing about the market. And for all of these rules, really, you know, it's easy to go back and talk about it and say, you know, don't do this, try and avoid this. But when you're in the moment, you really got to have discipline because it's so much temptation. But no matter what, you cannot take these entries from the middle of the zone at all. So that was from August the 7th. And then I want to talk about one from August the 8th. So I made this mistake back to back, double times, 2 times on 2 consecutive days. So that's not good. But on trade number 3, let's look at that. I shorted here expecting for prices to fall. Next time I should short from the top of the zone. So if you remember the concept we talked about for trades and tactics that work, when you have a spike to the downside, you have that spike in consolidation, you draw your zone up, and then you look to go short as prices come back and retest the top of that zone. Now I got a little bit excited right here. I thought that I knew what was going on because I'm like, ooh, it's a downtrend. We got a high volume candle right here. We should not come back and break past this candle. So let me just put my order there without seeing the reaction and getting the reaction I want. Let me just put my order there. Remember, we talked about that. Don't do that. So this is actually 2 mistakes and 1. But I put my order right there expecting for it to reverse, but prices came back up, retested the top of the zone, and then the downtrend continued. Now, luckily on trade 3, I was able to close this trade out really quick, pretty much at break even before it went against me. But still, I missed out on an opportunity that I could have had to take prices from 280 back down to the bottom of the zone at 250. I could have got 30 off of that, or if I held it, I could have potentially took it from 280 down to around 180 and would have took my profit when I had 100 points. So understanding these setups and understanding these rules is very important because a lot of times, even if you don't take a loss, the opportunity cost that you're giving up is just too expensive for you to be missing out on. So that's the biggest lesson I learned right there from rule number 6. Don't trade a zone from the middle. It's unreliable. So let's move on to tactic number 7, rule number 7. Using the higher low strategy when you are in the mature phase of a trend is unreliable. Skip these trades and wait for a deeper pullback. So let's go ahead and talk about that too. Now, when it comes to that higher low strategy, you know I love my higher lows. That's one of my favorite strategies to use when it comes to trading a downtrend. But just because the setup works a lot for you, you can't just get complacent and think that you can use it all willy-nilly whenever you feel like it and you're going to be right all the time. You might be right most of the time, but you got to make sure that you apply your strategy in the right situations and the right scenarios. So on August 1st, we had that happen to us. So let's go ahead and take a look at that. Let's look at trade number 28 over here on the right side of the chart. So on 28, well, really 27 and 28. 27, I went long almost at the highest prices for the day. The highest prices of the entire day was like let's call this 785. I'm going long right here at 775. That's 10 points away from the high for the day. That literally makes no sense. Now that goes back to the rules we talked about earlier. Buying high during an upswing, buying towards the highs during an upswing is just unreliable, and this is another example. So if you look at this, I went long at 27 and 28. The trend had started down here at around 35,660. So we were already a good, about 120 points away after we've had multiple pullbacks and multiple runs back to the upside. So the trend is very mature at this stage. So going long right here, even though it seems like it should work because it worked every other time, right? But on all of these other occasions, the trend wasn't as mature as it could have been. It was still in its early stages, developing stages, and then its maturation process until it finally became mature once it got to that 780 level. So to go long right there, it's just a low probability opportunity. And if you look, I did the same thing at trade number 28, which is not a good idea either, because if it didn't work the first time, you really don't want to come back and try the second time if it's the same exact scenario. So since the market didn't change right here, you still don't want to go long. So that's very important. When that higher low is coming at a place where the trend has already run its course, you got to wait and just be patient. I know it seems appealing, but more than likely a bigger pullback is coming. So let the pullback work itself out. Let the selling subside. Wait for a bullish signal to give you confirmation that the selling is over and that the uptrend wants to resume, and then you start going long. Now on this particular day, you should have waited until trade 29 when we saw this double bottom right here and then actually took the long trade as prices broke back above support one more time. So very important lesson right here. When it comes to those higher lows, you want to make sure that even though it's a good strategy, you don't want to go long at the mature phases of a trend or at the highest prices of a swing. And we actually, if we look at August 9th, I did the same thing right here on trade number 3. Went long here, expecting for the higher low to act as support, but the type of day that you're trading always matters. And this was actually a range bound day. So going long on a range bound day after a breakout is just extra unreliable. So also remember that too. So that's the biggest lessons I learned from number 7. When the higher low is mature, avoid it. It's gonna be tough, but you gotta have that discipline. You have to. So let's go ahead and move on to rule number 8. Using the higher low strategy during strong downtrends is too risky. Instead of thinking long, think short here instead. So let's talk about that. Let's talk about it. It's too risky. Now, that goes back to the previous rule where I said, yeah, you might like that higher low setup, but you have to use the higher low strategy in the right types of markets. When you're in a strong downtrend, that higher low setup is going to pop up because people have to take profits, and eventually there will be a higher low that gets created. But you have a choice and you have an option. You have to really decide whether or not that higher low is worth taking. Now, on this day, we can see that the uptrend had, well, you can't see it because we actually come into the screenshot after the uptrend was over, but before 1 o'clock, the uptrend was super strong throughout this entire day. But we stalled out as we got into the afternoon, and from that point forward, we created our lower high. So we took our swing high, we took our lower high, created a bear trend line by connecting those and then extending it throughout the market. So we pushed all the way back down to this level of support right here. And that is where I saw this higher low get formed right below trade number right before trade number 13. Now, yeah, this is a higher low technically, so you should use the higher low strategy, right? No, wrong. Because the downtrend is so strong, you got to skip those setups for those higher lows when it comes to a downtrend. Instead, like, here's what I do, because I just have a habit of seeing that higher low, drawing my level of support and extending it across. You can do that. That's fine. Just don't go long off of that level of support. Wait for prices to break back through that level of support, and then when they come back and retest it, when that level is now resistance, then that's when you want to take that short trade. So you can use the higher low strategy in a downtrend. You just don't use it to go long. You use it to look for the short trade. You look for that higher low setup to fail, and when that higher low setup has a failure, then you take the short trade. So in this scenario, on this day on August 4th, we look at trade number 13. So I went long here despite the bear trend line. Remember, the higher low setups don't work as well in down markets, and I think that's the biggest lesson to take away from here. Also, I made the same mistake on August the 8th this year too, and I did that on trade number 4. So let's read the notes for that. I went long here after seeing my higher low setup form, but remember that it's better to skip these setups in a strong downtrend, and that is so important because if you look at trade number 4, this was a perfect higher low downtrend reversal, higher low established setup. If you go back and look at all my notes, you would look at something like this and say, ooh, that's perfect. But the only thing is that we were in a downtrend, a strong downtrend. The higher low reversal setup works better in trends that are not that strong to the downside. Like, yeah, it's going to be a downtrend when you look for that setup, but you don't want to look for it in the strongest downtrends. And if you look at this one, this downtrend was very pronounced. We moved down, hit support, pull back up, lower high, push down, new low, pushed up, lower high, push down, new low, lower high, new low, lower high, new low. So when you're doing that all day, you really want to avoid those higher low setups. So look at what I did right here. I went long right here, yes, but even though I had my level of support drawn right here, look at what would have happened if I would have waited for prices to, instead of come back to that support and look for it to bounce. Imagine what would have happened if I would have let prices break through support, and then as they come back up to that level right here, boom, I could have took the short from 190 back down to 170 and been able to collect my profit target. And then I could have took that move multiple times as we came back up to support, but was never able to actually break back above that higher level support level that now is acting as resistance. So that's why you want to make sure when you're in a strong downtrend, you can use that higher low strategy, but just use it as a way to look for your short trades and not as a way to look for your long trades. So let's go ahead and move on to number 9, rule number 9. Okay, let's see. Take the first entry only whenever you see your setups. Actually, let's reword that. Only take the first entry whenever you see your setups. The second entry is unreliable. Unreliable. I wish I could make that big, bold, capital letters. Do not take that second entry. I think that's one of my biggest problems, because I'll see my entry come around the first time. I might hesitate and say, I don't know. Should I take it? Should I not? And then I miss it, which is cool. Sometimes that's just how it is. You're human. You're not going to be perfect. Sometimes you will miss trades, and that's okay. But what you don't want to do is start trying to take the second opportunity that you get. And the reason I say that is because on the first opportunity, you got to realize that as a trader, if you see a potential trade starting to form, other people in the market see the same thing as well. So if you're going to get in, more than likely they're probably getting in too. So it's a lot of people participating on the first attempt at a certain move starting to form. But once that move already runs its course, and then it might pull back and give you a second opportunity to get in, that move is just not going to be as lucrative, because it probably won't be as many participants on the second attempt as it was on the first one. Because if you made money on the first one, more than likely you probably kicking back, chilling, saying, okay, I'm gonna wait for the next best opportunity. So you get a second chance at that trade. Some people might take it, but a lot of traders won't. So you got to remember that. So let's actually look at some examples right here and let's talk about it. So if we look at trade number 22, this is a great example. I missed the first short trade and then tried to chase the market. So if you look at this scenario, coming into the screenshot, we were in a slight uptrend, but then we moved to a level of resistance right here at around 35,720. And then from that point forward, we pushed down, broke back down support, which is now acting as resistance. We pulled back up to that resistance, retested it, and then started to move down. So after that, we pushed back down to the bottom of the zone, had another lower high. So once we have a swing high and another lower high, we can connect those, extend that level throughout the market, and then create a bear trend line and use that as a reference point to go short from. Now, everything lined up perfectly. The bear trend line worked amazingly. The only thing was I should have went short right here after prices broke down, tested the bottom of this zone, came back and retested resistance right here, as well as retesting the bear trend line. Now, if we zoom in on this scenario, we can see that the touch of the level of resistance and the bear trend line by that candle was not perfect. But this is one of those scenarios where it's close enough to be good enough, and good enough is close enough. So you don't have to have a exactly perfect entry in the market, but if it's close enough, it's good enough to work. So that was a lesson that I learned right there too. Now, because I had my order towards resistance, I was not able to get my order filled, and I saw prices move from 680 all the way back down to around 655, and it would have hit my original profit target that I had. So I was super frustrated after that. And then I was like, you know what? Well, when it comes back to the bear trend line again, I'm just going to take the second trade. Well, that's not the case, because a lot of times in the market, the move comes, you have an opportunity, a window of opportunity. If you miss it, you miss it. But the second opportunity is just not the same. And this is a perfect example, because in this scenario, we found support down here towards these lows, bounced up, created a higher low, and from that point forward, the uptrend resumed. So that second entry, super risky. You can take it if you want to, but if you take a loss on it, you'll understand why. So that was one example right there. Second entry is unreliable. Where is... Oh, perfect example right here from August the 3rd this year. Let's look at trades 2, 3, and 4. So at 2 and 3, I went long at the zone twice, but didn't hold my trade to my target. That's another rule we'll talk about a little bit later. So we'll get into that also. Now on trades 2 and 3, if I would have took profits where I should have at the top of the zone or at the top of the bear trend line, I would have been great. I would have been real good on trades 2 and trades 3. So I had 2 opportunities right there to make profit, but I came back on trade 4 and still went long. Now on trade 4, during this day when I took this trade, I knew I was wrong. I knew it. And I was like, I know I shouldn't take the second entry, but I feel like this is the one time where it's going to work. No, stop. You got to stop having that type of mentality. If it didn't work before on previous days, don't think that this is the day where it's going to work out for you. Doing the same thing is more than likely going to get you the same results. So always remember that. So if we read the notes on trade 4, I went long at the bottom of the zone again, but my entry was just too late. And when it comes down to this rule, that's usually what it is. You have a late entry for a move that already happened. If you catch the move, you catch it. If you don't, you don't. But you wait for the next opportunity, and you do not chase that market, and you do not chase the opportunity that has already passed you. So that's one of the biggest things I was able to take away from lesson number 9, which is take the first entry only. Do not take that second entry because it's unreliable. So let's move on to lesson number 10. A trade that led to a loss before will probably have the same results if you trade it the same way later on. That's exactly what we just touched on. And I want to get into that a little bit more because I don't know about y'all, but for me, I have a tendency to always think that if it hasn't happened the way that I wanted it to for so many times, I feel like eventually I'm due for one, right? It can't go wrong 5 times in a row, can it? If it went wrong 4 times in a row, the 5th time has got to be the charm, right? Man, do you know how many times I sat there with that mentality and just kept taking loss after loss after loss because I just won't accept the fact that the same thing that didn't work before, if I'm doing it the same way now, it's not going to change. Like, look, most of the time this actually comes when you're in a range bound market because you might be trying to anticipate the breakout and you see signs that say, ooh, that right there is the sign that lets me know the breakout is coming, time to go long or time to go short in the expectation that the zone is going to break. And then you get stopped out and you say, dang. You look at it and you're like, oh, okay, it wasn't ready right then and there. So the next time it comes up, you're like, oh, if it failed last time after it almost did it, this is the time where it's actually going to work. No, that's not how it's going to go. If it went wrong 4 times in a row, it's going to go wrong 5 times in a row and probably 6 times in a row until you finally realize that you need to do the opposite of whatever it is that you're trying to do. So let's look at a good example of that. Trade it the same way. What's an example where it didn't work? Is this the right chart? This might not be. Oh, okay. Let's look at trades 9 and trades 10. I think we talked about these earlier, so let's go ahead and break it down into a little bit more detail. So on trade 9, I went short right here, expecting for the downtrend to continue, and of course, I was expecting for a breakout out of the zone, right? Didn't work. So I came back 2 candles later and was like, oh, okay, they tested the top of the zone and they're on their way back down. Let me take that same trade again. No, what happened? I got the same results. And let's see. 27 and 28 from August the 1st. We talked about that earlier, where I went long at higher prices at 27, came back, did the same thing at 28, didn't work. You know, you doing the same thing from the same levels is not really the most ideal trade. And then if you come back down here to 22 and 23 that we talked about from earlier, talking about how I went short at 22, right? But then I came back and pretty much did the same thing at 23, ignoring the fact that we had a higher low that got established. So don't ignore what the market is telling you. You know, if you were wrong, you were wrong. It is what it is. If you were wrong once, okay, accept it. That's part of the game. But you don't have to be wrong again. You really don't. It's up to you. The choice is all yours. If you want to keep pressing the issue, then hey, you know, trade to your heart's content, but understand that the probabilities of you having the same results increase if you're doing the same thing. Okay. And I actually, hold on, there's one more example that I want to talk about. I think it was May 9th. I don't know why I didn't put it in here. It was one of these days. Hold on, let's find it real quick. Let's see. No, too far. It must be before this. This was a long time ago. That was like months ago. Let me see. Where is it? Oh, okay. Here we go. Let's talk about this day right here. This is from May 4th this year. So let's look at trades 5 through 9. Now, right here, we had a downtrend. We came back, established a zone, broke out, came back to retest where the original downtrend had its first pullback at trade number 1. We retested that and then we moved lower. So let's look at 5 through 9. I completely lost it right here. I took the same incorrect trade 5 times in a row. Really, I have no excuse. I just simply made terrible decisions right here. And if we take a look at this, I knew that the trend was down, right? I had my bear trend line drawn, but this goes back to another rule we talked about, right? Where it says don't short from those lower prices, right? Because prices are going to pull back to an upper level of resistance, and then the sell-off is going to continue. And that's a perfect example of what happened through trades 5 through 9. I don't know what happened on 5, 6. It's kind of hard to tell. But I remember on 7, 8, and 9, and this is actually more than that. This is 1, 2, 3, 4, 5 different trades. So really, instead of it being 4 trades, this was 7 different trades where I tried to go short right here. None of them worked, but I kept taking the trade from the same level, being stubborn. But at this same junction, I had opportunities right here to short from higher prices as prices hit the bear trend line, to short from higher prices as prices came back to retest that wick that originally hit that bear trend line. And every time I had that opportunity, I gave up on it, and I expected a breakout from lower levels instead of shorting from higher prices and then just riding the breakout if you get that. Because the thing is, if you short from higher prices, you got options now, because you can either take profit at the bottom of the zone before the breakout happens, or you can anticipate the breakout happening and continue to hold your trade and catch a swing trade instead of a scalp trade. So you have options. But when you trade from the lows of that swing, you don't have options. You have one thing that can happen for you in order for your trade to be successful, which is the market has to break out. That's it. That's all that can work for you. So you're limiting your potential chances of success by trading from the lows of any type of zone, really. And then to make that same mistake multiple times, you can't do that. One of the rules I want to talk about, and I'm gonna talk about this a little bit later, and one of the other rules is that if a trade doesn't work 2 times, you got to abandon it. And I don't want to get into that too quickly, but we'll talk about that a little bit later also. But the moral of the story is, don't take the same trade multiple times and think that you're gonna get different results. That's just not how it goes, man. For real. Remember that. So let's move on. Actually, I feel like it's something that I'm missing right here, but am I? No, I think that's all we need for number 10. Just remember, don't keep doing the same thing if it didn't work. Oh, okay, that's what I wanted to say. On the flip side, okay, you don't want to do the same thing if it doesn't work. But for trades that do work, do those again. I've had a lot of scenarios on days like that where I take the same trade from one level and it works. Prices come back to that level again a little bit later on, and the trend is still the way that it was the first time that you took that trade. You take that trade again. So don't think that this rule is just a negative rule that only goes one way. It goes both ways. But you want to make sure that if it's not working for you, you don't keep pushing the issue. But if the trade is working for you, man, milk that trade and get as much profit as you can out of it until it stops working. All right. So let's move on to trade number 11. So we have reached the halfway point. We got 22 things to talk about, and this is number 11. Now, 11. Shorting against a higher low is unreliable. Immediately close all of your short trades if you ever see a higher low form. Now, this is one of those rules that you can never budge on. It's some rules that I'm going to talk about that are flexible, where it's like, okay, maybe 8 times out of 10 you use this rule, maybe 9 times out of 10 you use this rule, but this is one of those rules where 10 times out of 10 you have to follow it, or else you're gonna be a very disappointed trader. And take it from me, because I had to learn it the hard way. So hopefully I can pass these lessons along so you don't have to do the same thing. So on August the 1st, we are looking for higher lows, right? Let's go back to trade number 23. So notice how we talked about 22 earlier. We bounced off of those support levels, created a higher low right here, and I still went short. Now let's read the notes and let's talk about it. So I saw the higher low right here, but I thought it was a trap, so I still shorted. But don't try to outsmart the market tide. And that's so important. Like, no matter what you think the market might do, if you see that higher low get formed, you do not want to short against that, because a higher low is telling you that sellers had a chance to push the market down off of whatever swing from the downside just occurred, but it was enough demand and enough buyers that stepped in to actually absorb all of that selling and push prices back up to the upside. That's what a higher low is telling you. It's telling you that buyers are here. So even if you're in a very strong downtrend, if you see that higher low, you still don't want to go short. You want to wait for sellers to step back in at a level of resistance, and then you want to see a rejection from that resistance, and then you want to start looking for your entry. So no matter how appealing it may be, no matter what goes through your mind and what runs through your head that makes you think that you should continue to short when you see a higher low, you can't do it. Don't do it. Just get out. Get out. You don't have to be in that trade. You really don't. So another example. This is from August the 7th this year. We talked about this earlier in one of our previous rules at trade number 6. If you have that higher low, you cannot go short. Now on this trade, when I went short, the higher low was not established yet. The downtrend was still legit. But once prices broke back, once prices formed the next candle after I went long short at the orange triangle, they pulled back on this red candle right here, established really a double tweezer, and then moved up. That right there is a higher low. Now I had an opportunity to get out once that candle closed, but I still let my losses run all the way back to my actual stop loss, and I had to take a full stop on that when I really didn't have to. So when you recognize these higher lows and you're in a short trade, you have a choice. You can either let prices come back and you can take a full stop loss, or you can just take a little small loss or a break even loss if you can, and just get out and wait for a better opportunity and maybe look to go long in the future. So always remember, when it comes to a higher low, you don't want to short against it. And also on the flip side, when you're in a shorting a higher low. So shorting a higher low is one. The flip side would be going long after a lower high. So if you're in an uptrend and the uptrend is strong and you've seen it moving all day long, and then all of a sudden you get a lower high, no matter how strong you think the trend might be, you can't go long based off of that lower high, because basically it encompasses the same concepts as going short against a higher low. Just reverse all of the things and flip it and make it something that's the opposite of what I said earlier. So whenever you get those conflicting signs in the market, you do not want to fight against it, no matter how strong the trend might be and no matter how appealing it may seem. Do not fight against it, and do not try to go against that. Just be patient. Wait for the pullback to work itself out, and then when the pullback is over, you can come back in and start looking for whatever trade you was looking for from earlier. So always keep that in mind. That's very important. So let's move on to trade number 12. Be cautious when you counter trend trade. So I can't definitively say that trading a pullback in a strong trend is unreliable. Sometimes it works, sometimes it doesn't. So that's why I always say be cautious, because I'm still trying to do research and figure out what is the reason why on some days the first pullback is not a pullback that you can counter trend trade, but on other days the first pullback is a pullback you can counter trend trade on. So let's just look at some examples, and let me just give all the information to you, and let me allow you to make the decision that you want to. So look at this day right here. We had a move to the upside. We had news come out at 8:30 on this day. This was July the 12th this year. So we had news come out at 8:30. We pushed to the upside, and we created this zone right here. But then after the first pullback, we actually had opportunities to take the short trades. So we had opportunities on 9 and 10, and I actually went short right there. Took the same short trades here as I did on 6 and on trades 8. Saw profits as prices began to break to the downside. So this right here is an example where you have the first pullback and you can actually short that and counter trend trade against it. But here's another example from August the 7th. Let's go back to that trade number 6. This trade 6 is very important. It's allowing us to break down a whole lot of rules. I did a whole lot of things wrong on this one, but now we can learn from it. So notice how we had a strong uptrend right here, and then it kind of fizzled out as we got into this consolidation zone between 3 and 5. But then we eventually broke back down, created lower highs after we broke back down the level of support from that higher low. We pushed away, came back up, retested resistance, created another lower high, and then created pushing down, and then started pushing down, right? So I'm like, okay, this is setting up to be what I think it should be. You know, I usually don't want to take that first pullback in a counter trend, but on this occasion I can. But this was one of those scenarios where it didn't work. So I think on this one, Maybe it would have worked if I would have been able to get in like right here as prices came back to retest that level of resistance that used to be the support level for the higher low. So, I've seen so many days where that first pullback is tradable, but then that first pullback is avoidable, and I really haven't figured it out. So when I do, I'll come back, I'll update the video and give you some information, but just be cautious when it comes to that, because you never really know how it could go and what could happen. So let's move on to lesson number 13 that I learned. 13. Any wicks immediately outside of a zone have a high chance of being tested. Place your entries closer to the wicks instead of at the zone's edges. And this is a very important concept when it comes down to zones, because zones can be pretty tricky based on how you draw them. So let's talk about trades 1 and 3 from August the 1st this year. So if we look at 1 and 3, we had a spike to the upside when the market opened at 930, which eventually led us to a consolidation. So that's the spike in consolidation that I always like to talk about, aka a flag. So notice how I drew my zone based off of this higher low once we established this ellipse right here. So we pushed up. This was the first actual red candle that created a swing low, and then we pushed back up. So I used that as my my higher low right here, and then I used the zone from that reference point. Now, when you look back at it, that wick actually pushed down a little bit further than the zone. So I should have been able to pull my zone from the top of this candle actually to the bottom of this wick inside of the circle. That would have been the ideal way to draw the zone. And that's actually something we're going to get into a little bit later. That's one of the rules also, where I say drawing your zones or whatever levels on the chart correctly is extremely important. So we'll talk about that a little bit later also. So whenever you have those wicks below the zone, if you put your order at the zone, you got to expect for prices to come back and retest those wicks. Sometimes they might stay down there for a while. Sometimes they might come back and just tap it, wick it real quick, and then immediately move away from it. But either way, it's going to be some way, shape, or form that the market is going to come back and try and retest that level. So if you're going short at if you're entering at the zone, just remember that those wicks are coming back. So because I trade with such a tight stop, I can't really afford to take trades where it's not time for the move to happen yet, but it's about to happen. I got to get into the move when it is happening. So I got to remember that these wicks are going to get tested. And if you look at what I could have done differently, instead of going long at the zone, if I would have went long towards these wicks, I would have made profits on trades 1, 2, and 3. So, zones are very important. They look easy to trade, but they're actually a lot trickier than what the eye is going to tell you. So this is something that can help you when you trade a zone. Remember that those wicks immediately outside of it have a chance of being tested. And when I say immediately outside of it, I just simply mean like it's literally maybe 5 to 6 points away from the zone. Now, if you have a wick that's like way out of the way, like 20 points away, this rule doesn't apply. But when the wick is right there, this rule definitely is something that you can use. So let's move on to 14. 2/3 of the way through, we got 8 more to go. Very important lessons, so let's talk about them. Now, 14. A trade that fails 2 times should immediately be abandoned. It's okay to be wrong. It really is. That's part of the market. That's going to happen sometimes. But don't continue to be wrong. That's not what you want to do. Opportunity is abundant in the market. Remember that, It's going to be opportunity right now, a little bit later on, tonight, tomorrow morning, tomorrow afternoon, next week, next year, on your birthday, not on Christmas because the market is going to be closed. But it's opportunity all the time, and you want to make sure that you don't try and, force the issue when it's not working for you. And I think that's what we talked about on May 9th, right? May 9th, we talked about that. Now, let's see. Here's another really, really good one. This is from June 27th. Now, I remember this day right here. We had yesterday's closing price, the previous session's closing price from June 26th. Was at this green line down here. It's like 33,900 and let's call it 75. So I saw the downtrend happening. I saw a double top towards the top of the chart, right? We pushed back down, made a lower high. I caught the short trade right there. Cool. We make another lower high, another lower low, lower high, lower low, lower high, lower low. So at this point in time, I'm like, ooh, I see where the downtrend is going. I see the momentum. Yesterday's closing price is right there. Of course, we're coming back to test that level. Why wouldn't we? But you don't want to have that mindset, because you got to remember, you might have an idea in the market, but you always got to wait for the market to confirm it. And if the market doesn't confirm it, you don't want to keep pushing the issue and keep taking that trade and trying to force it. Because let's look at the notes and let's look at number 7. I shorted here as prices broke through support. Okay, that's a good tactic right there. But the trade hit my profit target, my original profit target, what it would have been. But I held on in expectation that yesterday's closing price would be hit. This trade eventually came back to break even. So, I gave up all types of points that I could have had because I'm looking out and trying to get a bigger amount, just not realizing that, it's not the time for that trade to work. So it didn't work the first time on trade 7. That's fine. But I come back on trade 8 and I take the same trade and I take a loss on it. That's not good, but it's something that you got to deal with. But then I come back on 9, 10, 11, 12, and 13 trying to catch that same move. So if it didn't work on 7, all right, you still got the green light. It hasn't failed 2 times, so you can still take that trade one more time. But after trade 8, bruh, you got to let that go. It's going to be opportunity in the market all day, but don't just take losses all throughout here, because then you're going to mess up your mentality going forward in the future. I could have caught the long trade right here, added to my position right here, and had a really good gain and took it back up to the top of the chart. But because I was in my feelings, I was like, man, I just want to catch my quick scalp trade. And I took it from the bottom at 14 back up to around 80, which was decent, but it wasn't the maximum profit that I could have gotten if I was in the right mindset. So that's another thing when it comes back down to forcing your issue when the issue is not there. You might get into the mentality where you think that everything that you do is wrong. And that's not the case. It's just everything you did wrong at that particular time based on that idea that you had was incorrect. But it doesn't mean that you're wrong as a trader. It just means that you were wrong right then and there. It's okay. Take your L, keep moving, and learn from it, Don't keep losing money. Your L can either stand for loss or it can stand for lesson. So it's up to you what that L is going to represent. So just don't force the issue. I could have took profit on 7, 8, 9, 10, 11, 12, and 13, and I probably would have been a millionaire. Not really, but you get what I'm saying, all right? I would have had a fantastic day. I wouldn't even have had to continue trading and take trade 14, so important that when a trade doesn't work, don't keep pushing the issue, man. Just let it go. It's all good. There's going to be plenty of opportunity all day long. So that brings us to number 15, which I talked about a little bit earlier, which is drawing your levels correctly makes a huge difference. The details matter, man. They really, 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 really do. So let's go ahead and talk about that. We talked about that a little bit earlier on trades from my previous days, but let's talk about this one. I don't think we've seen this day so far on this video. This right here is from July 27th this year. So on trades 1 through 4, I went short right here multiple times expecting for the zone to hold, but drawing the zone correctly is the key. Now, I say that because when I drew this zone, you can't see it. It's not on the screenshot, but if you look to the left, it was actually a consolidation area that I based this zone off of. But see, here's the only thing. The bodies for that consolidation area stopped where I drew the zone. But the wicks for that consolidation area that I based this zone off of, they actually extended back up to the same levels where this whole section of wicks right here is located. So this is where my zone should have actually been. Now you probably look at this and say, well, I mean, your zone is right here. The wicks are right there. That's not that big of a difference, is it? It is. Remember, I trade with a very, very, very tight stop. So 7 to 8 point difference makes a large impact on my trades, because that 7 to 8 points could be the difference between me not getting stopped out and me having my stop get hit and then having prices reverse exactly from where I got stopped out at. So it's very important to get the level exactly correct and have the level as extremely precise as it possibly could be. Because if you look at what I did on trade 1, I went short right here, right? But if I would have went short towards where the wicks were, I would have took that loss on trade 1 because they definitely came back and stopped me out right there. But on trade number 2, I would have been able to take the short trade from right here. I would have been successful as prices came back into the bottom of the zone. Right here, I would have been able to catch the same trade from the top of those wicks, take prices back down to the bottom of the zone. So I came back on trade 5, was able to make profit, but that wasn't even enough to cover the losses that I made on 1 through 4. So that's why drawing those zones perfectly is so important. So when it comes down to drawing the zone perfectly, really the only way you can do that is to put more practice in. you're not going to be able to learn how to draw the zone the perfect way from trading a live chart because it's just too much pressure, just too much going on. You got to figure out how to do this in practice first and then do it in the game. It's like if you play basketball and you never dunked in a game, but you try and dunk for the first time in a game, you probably going to miss because you never actually tried to do that under a pressure intensive situation. Now, if you do it in practice and you learn how to do it when there's no pressure on you and you finally become comfortable with it, then you can feel like you have the guts and bravado to be able to do it when the pressure is on. So really, if you want to draw a zone the right way, practice, 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 because practice makes perfect. That's right. So that's 15 right there. Let's move on to number 16. Zone entries, they got to be perfect, man. Can't get greedy. So let's read that. Take what the zone will give you. Zone entries got to be perfect. Don't get greedy. So let's talk about it, man. When it comes to a zone, what I talked about earlier was that a zone can be really tricky to the eye, and I really believe that wholeheartedly. And the reason I say that is because you might think, looking back at it, that the zone is just easy to trade. You go long as it gets down to the bottom of the zone. But what I've learned in my experience is that if the zone is clearly defined, everybody is pretty much looking to go long as prices come back into the bottom of it if the trend is up and we establish a zone. So if you think that you can just take your time getting into the market when it comes down there and you'll have time, the market is going to give you plenty of chances. If that's what you're thinking, you'll be very disappointed because prices come back down to that level, but because it's so much demand at the because it's either so much demand or supply at the extremes of a zone, they move away from those edges of the zone very rapidly. And it's hard to really tell that when you're looking just back on the chart. But when you see it forming in real time, man, these zones can move, man. So you got to remember, you got to be quick on your feet. Your entry has to be perfect. You can't trade the zone from the middle like we talked about earlier. You got to trade it from the extremes, and you have to trade it from the best possible price that you can get, or else you run the risk of either your trade coming back to break even or you getting stopped out on the worst occasion. So always want to make sure that you remember your zone entry got to be perfect. Now let's talk about the second part when it comes down to this. Now this is from Tuesday, May 9th. I'm going to use some examples from this day to talk about what I want to talk about when I say don't be greedy. Look at what happened for me at trade 12. Look at what happened on trade 7. Excuse me. On trade 7, I had an opportunity to take prices back down to the lows, get out right there and take profit. But I didn't do that. I let my prices come back up and stop me out at break even. On trade 12, I had an opportunity after I shorted right here towards the top of the zone. I had an opportunity to get out at the bottom of the zone. Now on this particular day, look at this right here, man. I had 1 chance, 2 chances, 3 chances to get out of this move, and I squandered those opportunities all of those times. Now luckily on this day I was able to come back on 13 and catch the actual breakout, but on a lot of days where there isn't a breakout and it just stays in between the zone, you're pretty much giving the market your profits back. Like, here market, I don't want to make any money today, you can have it. Either give it all to me or give me nothing. That's not the mindset you want to have. You know, it's plenty of profit to be taken if you accept what the market is giving you. So don't be greedy, man. If the profit is there and it makes sense, take that. And if you want to trade the breakout a little bit later on, you can do that too, but lock in the profit that you have now so you can increase your trading account and run up your numbers. That's all it's about. So let's move on to 17. Take your profits when prices hit key levels that make sense. Don't get greedy. Like we said before, opportunity is abundant. So you're seeing a lot of the same concepts throughout all of these rules because a lot of them really kind of commingle with each other and tie into one another. And this is another one of those examples. So when you have profits that get to a key level, take it. Now let's look at trade 14 right here, because I think this is probably one of the examples that I still dream about. And I'm like, wow, you remember that trade on August the 3rd from trade 14 when you could have had that real good trade, Ty? You could have, but you squandered it. Now let's look at trade 14. So we see that the trend was up. Yeah, we broke above the zone. We came back to resistance right here at the red line. We pulled back. Now after we pulled back, we came back to support. And then once I saw prices retest support, no, I didn't go long right there, just having my order right there. I learned that lesson, but I waited for the reaction. I waited for prices to move away from support. And then as they're moving away from support, I go long and I look to take it back up to the top of the zone. Now right here, because the uptrend had been so strong all day, I just figured, man, I'm gonna hold this trade for the rest of the day and just see how far I can go. Okay, like you might have thoughts of grandeur when you're in the market, but stay focused and stay self-centered. Stick to your plan and stick to your rules. If the market comes back up to a level that makes sense, this was a zone that during the pre-market prices were up here but weren't able to break it either. So for prices to come back to that level again once the market opens, it only makes sense to take profit right there. And I actually gave up. I don't think I have the notes for part one, but I gave up. I went long right here at 350. The top of the zone was 380, and we actually peaked up all the way to like 385. So I let a 35-point trade come back to break even. And the reason that I wanted to hold this trade so bad was because we had yesterday's closing price up here at this little orangish, yellowish dotted line right here. That's the previous session's closing price from August the 2nd. So I'm like, ooh, the level is right there. I might as well hold it. But if we haven't been able to break above this zone all day, you can't just assume that this is going to be the time where we break it. It goes back to the rule we talked about earlier, where if it hasn't happened before, don't be the one to expect for it to actually happen. Follow what the market is telling you. If that's been the top level of resistance all day, take profit right there. And that's one of the biggest lessons I took away from trade number 14 right there. And that's just one example that I have, but I have so many examples going further back into the past where I'm being greedy. I'm trying to get more than what the market is offering, and I'm just not capitalizing on what the market is really giving me. And that's costing me, because you're going to take losses in the market. It's guaranteed. You can't avoid it. But in order to kind of wiggle yourself out of those losses, you want to make sure you take profits on your trades that work and lock those profits in so that when you do come across a storm, you can weather it. That's why it's so important for rule number 17 for you to take prices when they get to important levels that make sense. So 18, let's go ahead and get into that. Do not anticipate the end of a pullback. Instead, you need to wait for a new higher low or a new lower high, depending on what kind of trend you're trading. You need to wait for that to be made before trading with the trend again. I think we talked about that earlier, but let's talk about it a little bit more, because on this day right here, July 18th, this is a perfect example of what I'm talking about. So on 4 and 5, I got a little bit too excited right here. I went long but quickly cut the trade as it turned negative. On 6, I went long at the zone's lows, cut quickly as it turned negative. 7 and 8, I made the same mistakes from trades 4 and 5. You still need patience when you trade a strong trend. So really, just because you see that the trend is strong and we're pulling back, that doesn't mean that you just blindly go long at support. No, you let prices come back into support. Right now, today we had support at the blue line down here right below the zone. Notice how when we came back into support, we created a double bottom, and then we created a higher low once we broke back into the zone. That right there is where you got the confirmation that the uptrend is back on, and now you can start looking to take those long trades that you were looking for earlier. So even though the trend might be strong, you always want to make sure you let the pullback shake itself out, and then when the pullback is over and you have confirmation that it's over, that's when you can go ahead and get back into those setups that you were looking to take. So very important. Do not anticipate the end of a pullback, and really don't anticipate any level holding up. You know, whether it's support, resistance, it could be yesterday's closing price, it could be last year's closing price. It doesn't matter what it is. Don't just expect for that level to be important. Look for that level to be important, but make sure you get the reaction first from the market, because you want to make sure everybody else in the market feels the same way you do, so that way your trades have a better probability of being successful. So let's move on to 19. We got 19. We got 4 more to go, man. Let's hold in there. Stay strong with me, you guys. On 19, bear trend lines are unreliable during an uptrend. Use this in a downtrend only. And I learned this lesson the hardest way, so let's talk about it. On July 28th, now this day, once we look back at it, all the way up until 11:40 in the morning, we had a very, very strong uptrend. Definitely, right? But take a notice of how every time I had that bear trend line form, it really didn't work until the market flipped back over to the downside. Now, if you look at this bear trend line right here, everything that I look for to establish a bear trend line happened perfectly. We had a swing high followed by a lower high. So we take those 2 points, we connect those, and we extend that line throughout the market and use that as a reference point to look for short trades in the future. All of that makes sense, but only when the trend is down. When the trend is up, you can still see a perfect bear trend line setup. But what you want to do, this is actually similar to that higher low setup where you can still put that setup on the chart and draw it up. But instead of actually trading it based on it being successful, you want to trade this expecting for it to be a failure. You want to see prices break back above that bear trend line, establish a higher low somewhere above or preferably right on top of that bear trend line, and then that's when you look for your long trade. So when you're trading a bear type of setup in an uptrended market, don't look for the bear trend line setup to be successful. Look for it to fail. And when you're trading a bullish setup in a bear market, don't expect for that bullish setup to be successful. Expect for that bullish setup to fail. And when it does fail, then you take it. So that's one of the biggest things I learned about bear trend lines. And then if you follow the market across over here to around 945, we had the same thing happen where created a double top, had a lower high right here. From that way, I extended my bear trend line through the market and used it as a reference point. But I tried to go short on 2, 3, 4, and 5, took losses on all of them. And that goes back to the rule we talked about earlier, which is if a trade doesn't work 2 times, it's a reason. And you need to immediately abandon that trade until you get more clarity in the market or until you hop back on the right side of the market and do the opposite of what you were doing at that time period. So these bear trend lines, when it comes to an uptrend, they don't work until you have a pronounced downtrend. Now, that actually happened once we hit that 11:40 a.m. time period. So look at how we formed the head and shoulders right here. That's the left shoulder, it's the head right here, it's the right shoulder right here. Then we had another lower high coming out of that right shoulder. So that's even more confirmation. We finally break the neckline. We pull back up, but we only pull back up to retest that neckline. And then from that point forward, we had a double top followed by a lower high that came back to be retested by way of a double top. So after you see all of those bearish signals in the market, then that's when you can start looking for those bear trend lines to start working. Now, if you see, we had a bear trend line right here that we drew from a swing high that was established from a swing high connected to a lower high, and then we extended that. So when prices came back to retest that zone level one more time where we had a touch before, what happened? The market went down because those bear trend lines work better when you already have all of the various signals in the market. So you always want to make sure that you use the proper setups for the proper type of market environment that you're trading in. That's very important. Number 20, give yourself at least a 2-minute cool down after a really good trade or after a really bad trade. And that's what I learned on May 4th. We talked about this a little bit earlier. So notice how after I took trade 7 and trade 8, to me, those were 2 really bad trades because I'm trading in line with the trend, but I'm still getting stopped out. So that's not good. That means you're entering from the wrong level. So, once you get that wrong 2 times, you got to say, man, I'm doing really bad right now. Let me take a step back, because as a trader, you have an emotional barometer that can swing from extreme to extreme. On one end of the spectrum, you have, extreme elation, where you made some really good trades and you feel like everything that you do from this point forward is going to be profitable and it's going to be the best trade you ever took. That's one end of the extreme, one end of the spectrum. But then you have another extreme at the other end where you just extremely, non-confident in your abilities. You feel like whatever trade you make, it's just not going to work. The market is against you. The market has something out for you. They don't want you to profit. They don't want you to succeed. They want you to be broke. They don't want you to live your best life. You can feel like that sometimes because you're taking bad trades. But what I can tell you is that no matter what end of the spectrum that you're on, whether you're on the happy side or the sad side, is not what you think it is. When you think that everything that you do is going to work, you're not as good as you think you are. When you think that everything that you do won't work, you're not as bad as you think you are. As a matter of fact, you're somewhere in the middle, and you want to try and stay balanced between that spectrum. And a good way to do that is using this 2-minute cool down. So whenever you're feeling those emotions, just feeling emotionally charged, That's when you take a step back for 2 minutes. For me, I say 2 minutes because I trade a 1 minute chart and a lot can happen. So you don't want to stay away from too long, but you want to stay away long enough for you to really allow yourself to say, all right, I'm not taking my best trades, but if I analyze the market correctly, I can. The same way when you're having really good trades, you want to say, wow, I'm doing really good right now. I could probably come in and try and push the issue, but let me step back and make sure that the next trade that I take is a high quality setup, just like this trade I took before, so that way I can get similar results. You know, that's very important. So that's one of the biggest lessons I learned when it comes down to trade number 20. Give yourself time, you know. It could be a 2 minute cool down or whatever number you pick based on who you are as a trader, but just do what works for you. But remember, you're never as good as you think and you're never as bad as you think. It's somewhere in the middle. So that brings us to the second to last topic that I want to talk about today, which is rule number 21. 21, let's read that. Never revenge trade after a tough sequence in the market. Never. Accept the disappointment, man. You can't change the past. Wait for the next good opportunity. It's all good. We talked about that all day today, right? It's always more opportunities. So don't take your L's and take them personally. You got to take L's in the market. It's just a part of the process. But the way that you take your L's is a very telling sign about what kind of trader you'll be. You got to be the best loser that you can be, because when you take L's, you can't come back and keep trying to force the issue. You just got to learn your lesson, roll with it, and then keep moving forward. So, and definitely don't take a revenge trade. So let's look at trade number 19 right here from August the 1st. So if we look at 17 and 18, hold on, let's go back to 16 actually. So on 16, I shorted after a double top rejection. I had decent profits, but this would have been a phenomenal trade if I took profits at the right levels. Now I should have took profits at the bottom of the zone, but I got a little bit greedy. I still was able to get decent profits on it, but to me this trade was a failure because I could have got almost double my profit target if I wouldn't have just been so stubborn. But that's all good. You know, that's something I can learn from. But I come back on trade 17. It was a continuation of trades 15 through 16. I also had trouble taking profits here. Got too greedy. We talked about that earlier on some of our other rules too. Got too greedy where, you know, I had an opportunity to get profit and I didn't take it. You know, that was on trade 17. I could have racked up. On trade 18, I could have racked up, got out at the bottom of support down here at 650. That's a major half number level in the market. It makes sense to get out right there. But I didn't do that. And then I came back to trade 19 and I was super frustrated because I expected for me to be able to take that trade from 15 really all the way back down to 19. Now, took a loss on 15, but on 16 I came back. But throughout this whole process, I wasn't able to capture that entire move like I wanted to. And I was like, you know what? I'm just going to short right here at 19 because I'm frustrated. And if we read the notes, it says, I was super frustrated after missing profits on trades 15 through 18. I revenge traded right here. I saw the higher low, but I still ignored it. And that's why you don't want to revenge trade, because it's like your anger is really getting the best of you and it's not allowing you to really analyze what's right there in front of you, because you're saying, no, the market is going to do what I want it to do. And if it doesn't, I'm going to force it to. But it's nothing you can do to make the market move, man. Unless you just trade thousands of contracts. But those people are few and far in between. And even those people can only move the market for a certain time period. Maybe they might move it a point or two. But then all the other traders are going to come in. So at the end of the day, you can't make the market move. The market is going to move the way it wants to. So you got to read what the market is doing. You never get to tell the market, this is what you do. The market gets to tell you, this is what you do. So you just listen to what the market tells you and you follow that, and you don't revenge trade. So make sure that when you do have trades that are frustrating, like when we go back to the notes, what do the notes say? It says the most important thing that I can tell you guys, accept the disappointment. That's something just in trading overall, not even in trading. I'm not trying to go too deep, but in life, you got to be willing to accept disappointment because it comes, you know. Sometimes you're going to get what you want, but sometimes you won't. So in those times where you won't, what you going to do? You're going to throw a temper tantrum like, no, it has to do this. Why won't it do it? Like, chill, bro. Take your L. Remember what we said earlier. What is your L going to represent for you? Is it going to represent a loss or is it going to represent a lesson? It's up to you. but you got to accept that disappointment before you can do any of that. So it's very important. Can't change the past, but you can wait for the next best opportunity. Can't change what already happened, but the future is in your hands. Remember that. So that's one of the biggest things I learned from 21. Don't revenge trade. And I've revenge traded way more than the examples that I have in here, but I just wanted to keep it short. I know we're getting to the end of the video. So last but most definitely not least, rule number 22, going long at the top of a trading range is unreliable. And this kind of ties into rule number 1, where buying the lows of a, it ties into rule number 3, where buying high is unreliable. So it kind of, trade number 22 kind of follows the same thing, but in this situation we talk about zones and we talk about trading ranges, because like if you think you don't want to go long at the highest prices during an upswing when the market is trending, I promise you definitely don't want to go long during a range bound market where we're coming up to the top of the range. So let's look at trade 6 right here. I went long during the uptrend as prices came back to test the zone. Break even stop got hit. Now, luckily my break even stop got hit on this one. I got lucky, because if my break even stop didn't get hit, man, you see what happened. That would have been very disappointing. But when it comes to a consolidation range, when you're at the top, you cannot go long, because that's where everybody is selling out at. So if people are selling out and taking profits right there, it's going to be a wave of selling that comes in and pushes the market down. But then you got people like me that went long right here at the top of the zone. When that wave of selling comes in, then that's when my stop is going to get hit. So all of the people like me that are getting their stops hit because they bought at the top of the zone, you add that in to the selling pressure that's coming in from the people taking profits, it's usually going to be enough momentum to push prices back down, either to the bottom of the zone or the bottom of the trading range, depending on what type of day you're trading. So that's one of the biggest lessons I learned right here at trade 6. And we can see the same thing at trade number 2 on this day from July 17th. So let's read that. I went long right here expecting the bull spike to continue, but you got to buy low no matter what. Can't buy high, especially not at the top of the zone. Now the market is going to tempt you. It's going to give you temptation and make you feel like, oh, the market is going to move without me, so I need to go long right here, right now. Nah, that's probably not what's going to happen. More than likely, as soon as you get to that point where you think the market is moving without you, that's when it's going to pull back. So fight your urges, use your discipline, and use your patience. And when we look at trade 3, I did the same thing right here. I went long after I thought what I saw was a continuation pattern, but it just wasn't the case. You know, continuation patterns only work on certain types of days, and that's important to remember. And then I came back and did the same thing once again at trade number 5. I think this was one of my biggest problems on this day, July 17th. And on trade number 5, if we read the notes, it says, I can't go long at the highs during the uptrend. It leads to too many losses. And that's clearly evident right here, because if I would have went long at the bottom of the zone like I was supposed to at the purple line right here, I would have been able to rack up profit every time. If I would have went long on 2, 3, 4, and 5 at the bottom of the zone, I would have been a very happy trader on this day. Now we come back to trade number 10. I did the same thing right here. Went long here, but bought way too high. And, you know, that cost me, because then I started really questioning myself. And that's something that could happen in the market, where you just start taking bad trades after bad trades. You might forget that you actually know what you're doing in the market, because you're putting yourself into such unfavorable situations that it really throws off your mental psyche. So the biggest thing for these rules, and the biggest reason you want to follow these rules, is to keep your mind frame in the right state of mind. If you think positive, more than likely your results will probably reflect that. If you think negatively, your results more than likely will probably show that you were thinking negative all day, and your results won't be that good. So those are the 22 lessons and the tactics that I learned to avoid. So I just wanted to come through and, you know, give a synopsis on all of the lessons that I learned. Make sure you check out my other video, trades and tactics to actually follow, trades and tactics that work, as well as trades and tactics to avoid. So I hope you guys were able to take something away from these lessons that I got for you. If you ever need to come back to this video when you're studying the market or something, don't hesitate to use this as a reference point for you going forward in the future. And man, look, I hope you enjoy it. But until then, you guys, I'll see you later. Y'all take it easy now.